Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Kenvue.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. Kenvue is it's fascinating right now because the investment narrative really hinges on a contradiction.
A contradiction? How so?
Well, if you just look at the surface, the immediate financial print,
Mhm.
it suggests struggle. But when you look underneath, you find this massive structural inflection point happening in profitability.
Okay, let's start there then, with the struggle. The Q3 2025 results were definitely a bit concerning on the top line.
They were. We saw net sales of $3.76 billion. That's a 3.5% decline year over year.
Right, and if you strip out currency effects, organic sales were actually down even more, like 4.4%. For a consumer health company, that kind of sales dip, it raises some serious questions.
It does. And the big question is, why should investors look past that? Because that revenue softness is entirely masking an incredible margin story. And that is where the true value lies. The management team. They executed flawlessly on costs.
You're talking about the gross margin expansion?
Yes, it expanded dramatically to 59.1%, and the adjusted gross margin hit a whopping 61.2%.
Wow. That kind of expansion in a quarter where volume is falling, that's a huge signal.
It's a massive signal.
61% adjusted gross margin is certainly impressive, but I have to, play devil's advocate here.
Please do.
If sales volumes are shrinking by over 4%, aren't these margin gains just the result of cutting too deep, maybe into R&D or marketing, potentially sacrificing future growth?
That is the critical question, and the analysis suggests the gains are, well, they're structural and sticky. This wasn't just about reducing ad spend.
So what was it then?
The lift was driven by multiple factors. First, highly successful premium pricing on their core power brands like Tylenol. Second, aggressive SKU rationalization after the spinoff, basically cutting inefficient products.
Okay, that makes sense.
And maybe most critically, they've optimized their supply chain. They consolidated 3 major packaging lines, which significantly dropped their cost of goods sold. That's a structural improvement, It doesn't sacrifice future growth.
So they're proving they can extract superior efficiency from this huge portfolio, even when the consumer is a bit soft. And that execution translated directly to the bottom line.
Precisely. Which is why we saw the earnings resilience. Adjusted diluted EPS came in at $1.28.
Just beating the consensus of $0.27.
Right. And this is where we start seeing a pattern. This isn't a one-off. Kenvue has now delivered these little execution-driven surprises, small beats, in Q1, Q2, and Q3 of 2025.
That's just consistency. It shows they can really manage their expenses.
It does. And despite the volume challenges, management is clearly confident. They reaffirmed their full-year 2025 adjusted EPS guidance.
Between $1 and $1.05, I believe.
They did. And what's even more striking is that the sell-side analysts are actually more bullish. The street expects something closer to $1.14 in EPS for the full year.
Interesting. So that discrepancy tells you that analysts see this margin expansion not just continuing, but maybe even building operating leverage.
Exactly. It provides a deep cushion against any future macro shocks.
So the quarter shows they can manage costs, but let's talk long term. Is this margin strength sustainable, or is it just tied to the incredible defensive nature of the assets they own?
Well, we have to remember this is a portfolio built on generational trust. Post-spin, it's the world's largest pure-play consumer health company.
Right. We're talking about absolute iconic brands.
I mean, Tylenol, Motrin, Listerine, Neutrogena, Aveeno, Band-Aid. These brands are not fads. They are permanent fixtures in medicine cabinets all over the world.
And that kind of brand power guarantees 2 things: premium shelf placement anywhere you go, and reliable pricing power, which is critical in an inflationary environment.
Absolutely. And that brand trust is the foundation of the competitive moat. It's much deeper than for typical consumer products. The barriers aren't just clever marketing. They're fundamentally regulatory. When you're dealing with over-the-counter medicines, or even something like Neutrogena, the hurdles, the testing, the quality control, they are enormous.
It's not like launching a new flavored beverage.
Not at all. The cost and time to get OTC drug approvals creates a massive barrier to entry. A competitor simply cannot replicate the level of, multi-generational trust that a bottle of Tylenol carries.
My mother used Listerine, I use Listerine. That kind of habit.
Exactly. That low consideration purchase behavior is priceless. And that deep moat protects pricing and ultimately profit.
And that durable moat translates directly into financial defense, which makes the company an appealing place to hide during volatility. Market cap is around $32.1 billion.
And it's highly defensive. We see this in its low beta of 0.59.
That's a key selling point. A beta of 0.59 means if the S&P 500 swings, say, 10%, Kenvue historically only moves about 6%.
It gives investors that built-in downside protection.
And all of that stability is underpinned by just a prodigious free cash flow engine.
It really is. We estimate Kenvue is currently generating around $1.67 billion in annual free cash flow.
That's serious cash generation.
It is. But here's the critical long-term number, that FCF is expected to accelerate dramatically, rising toward $2.8 billion by 2029.
Okay, that's a huge jump. Why the sharp acceleration? What unlocks that?
It's primarily driven by the conclusion of legacy agreements with the former parent company. After the spin-off, Kenvue had to pay for various services under transitional service agreements, or TSAs.
And those are expensive.
Very. As those agreements sunset over the next couple of years, Kenvue instantly sheds those massive costs, that operational cleanup plus compounding scale benefits. That's what fuels the rapid conversion of revenue into much higher free cash flow.
So, robust and accelerating cash flow, incredible brand loyalty, strong balance sheet. This sounds like an incredibly premium asset.
It does, right.
Yet the stock price has just been in the mud. So what does the valuation disconnect look like right now?
This is the crux of the opportunity. If we run a detailed discounted cash flow analysis, which is, an intrinsic valuation method based on those future cash flows, it suggests the true intrinsic value is near $28.66 a share.
That's a massive gap. The stock has been trading near, what, $16.93?
Correct. It implies the market is pricing the stock at a substantial discount, roughly 41% below its calculated fundamental worth.
So the market's pricing in all the current revenue softness, all the historical liabilities, and completely ignoring the fundamental cash-generating machine.
It's pricing this asset as if it were facing terminal decline. That discount suggests massive downside protection is built right into the current share price.
It creates a classic asymmetric setup then.
It does. Limited downside risk, protected by cash flow and stability, with a substantial upside if the market simply re-rates the quality of the business. But to understand the opportunity, we have to acknowledge the pain that got us here.
Right. The long-term pain is real. The stock is down about 27% over the last 52 weeks and has dramatically underperformed consumer staples.
It has. And technically, it had been trading below both its 50-day and 200-day moving averages since June. A deeply negative picture.
Just signaling serious distress.
A picture of crowded pessimism. However, the reaction to earnings on November 3rd was a powerful signal. Following those Q3 results, the shares jumped about 12.3% in a single day.
And that's what you classify as a strong earnings gap up.
Exactly. And those gap ups are often the first sign of a trend reversal. It signals the worst of the news is probably priced in, and investors are finally starting to reward execution.
So that rally changed the immediate technical landscape.
Fundamentally, we now have established near-term support around the 50-day moving average, which is sitting near $16.10.
And the key resistance level, the first logical target.
That would be where the 200-day moving average sits, so somewhere between $19 and $20. Breaking and holding above $20 would officially flip the narrative from bearish to structurally bullish.
Now let's talk investor flow and sentiment. This is where the contrarian argument gets really compelling, I think. If we look at options trading, sentiment is still heavily bearish. You're seeing elevated put demand, which just screams skepticism, even after the earnings beat.
And that bearish options positioning for a long-term investor is potential fuel. It means there's crowded pessimism. Once the fundamental story confirms, that positioning can lead to a really accelerated move higher as the bears are forced to cover.
But the smart money, the patient capital, they aren't waiting for that technical reversal.
No, they are not.
We've seen steady patient institutional accumulation, large long-term funds, names like the California Public Employees Retirement System, Federated Hermes, Guggenheim. They're quietly building multi-million-dollar positions right here in the mid-teens.
And that institutional accumulation is maybe the most important confirmation of the whole thesis. These aren't fast money funds looking for a quick trade.
Right. These are long-horizon, fundamentals-driven investors.
They're building a core defensive holding based on that accelerating cash flow and brand quality. They are actively buying into the weakness, anticipating the inevitable re-rating.
Okay, that brings us to the risks. We can't analyze Kenvue without addressing the legal overhang it inherited. What's the biggest hurdle right now?
The primary risk remains that legal overhang. Specifically, the Texas AG actions concerning procedural business registration violations.
Which carried that severe headline threat of a potential state business ban.
Exactly, and that has been the single biggest sentiment killer for the company since the spin.
So let's dig into that. What's the realistic worst-case scenario? Is this an existential threat or is it a regulatory headache?
Well, legal analysts suggest the threat of a full state ban is minimal. It would create a massive disruption to the supply of essential healthcare items. Tylenol, Band-Aid. Regulators don't typically do that.
So it's far more likely this resolves through a fine or a settlement.
It is. The risk isn't so much the financial cost, which is probably already discounted by that 41% valuation gap. It's the persistence of the headline risk that keeps the multiple from expanding.
Right. If that headline fades, the market instantly focuses back on that $2.8 billion FCF engine, and the valuation gap should close pretty quickly. What about the secondary risk, the top-line weakness?
That remains a risk for sure. If volume declines continue, it puts pressure on organic growth. However, the Q3 print provided a really robust counter to this fear.
Because management proved they have the operational levers?
Yes. Strong pricing power, diligent cost controls. They showed they can offset that volume pressure and protect the critical earnings per share number. They've demonstrated they can navigate a tough consumer environment without sacrificing profitability.
So management has proven they can execute. Let's look ahead. What are the upcoming catalysts that could drive the stock from, say, $16 to that intrinsic value target of $28?
The immediate catalyst is just continued execution. The next earnings call, February 5, 2026, will be crucial. Another EPS beat, coupled with any sign that volume is stabilizing, that will be necessary to accelerate the reversal we're seeing.
And what if the broader macro environment deteriorates?
That actually becomes a tailwind. The low beta of 0.59 positions can view perfectly for a defensive rotation. If investors lose confidence in high-growth names, capital will rotate aggressively into high-quality, free cash flow-rich companies like this one.
It becomes a safety trade.
It does. It drives institutional demand.
And finally, what about the more speculative upside? I've heard talk of potential portfolio optimization now that it's a standalone entity.
Absolutely. Management now has full authority to optimize their assets. We could see them prune smaller, non-core brands or maybe pursue small, bolt-on acquisitions in high-growth areas like dermocosmetics.
Anything to accelerate the mix toward higher-margin products.
Right. And of course, the single biggest catalyst is that multiple expansion once the legal issues finally fade. That resolution removes the uncertainty and instantly unlocks the value trapped by the headline risk.
It really brings us back to the core thesis. This feels like an iconic, stable asset being traded at a massive discount simply due to inherited noise and some temporary weakness.
That is precisely the summary. Kenvue offers iconic, cash-generative brands at a deep discount. It's a genuinely asymmetric opportunity. The downside is protected by that robust, accelerating free cash flow stream, and the execution on margins is proving the quality of the business.
So the key takeaway for our listener...
The key takeaway for you, the listener, is that this stock requires patience, but the market eventually rewards stability, predictability, and reliable cash flow. We believe the substantial upside becomes, well, almost inevitable as the market fully re-rates this standalone story over the next 12 to 36 months.
A compelling argument built on operational execution and hidden value. Thank you for walking us through that. If you want more in-depth stock analysis every day, make sure you are subscribed to Smart Wealth with Joshua for daily insights.